Seven Legal, here with my colleague Saman Harris, who heads up our head of commercial and fractional GC offering. So I'll just share my screen actually, if that is good. Okay. Sorry, there we go. And,
It's coming.
Oh, perfect.
Excellent. Did you all see that?
Yep.
Yes.
Brilliant. Sorry about that. It was there was a few hidden icons knocking around. So yeah, no, as I said, yeah. So Seven Legal, I founded Seven Legal in March 2020. We're now a group of 20 lawyers helping companies through their stages of funding, scaling, and exiting. So what that means for us is we're advising clients from a legal perspective when they're taking on investment, and then post-investment as they scale. So in terms of commercial contracts, data protection, trademarking, employment and equity schemes, right through that messy growth phase, and then exits as well. So right through to M&A and back end. We have lawyers in the UK and the US, so anyone expanding across the US, we can also help with that jump across in terms of Delaware flips and US launch as well. And then for our more mature businesses, we have a fractional GC offering where we drop lawyers into businesses to help them with building out the infrastructure of their business as they scale. So that is us. And then our mission is to solve complex legal problems simply. So today we're talking about term sheet negotiation. So the way we're going to position this is essentially walk through what a typical VC term sheet looks like, and give you an explanation of, look, every part of that term sheet, but also gives you perspective as well, both from the investor side and the company side. So understanding, what are the most important areas to concentrate on a term sheet, what is market, what you should be pushing back on, and red flags as well to avoid as you go through. Probably the best book on all of this is Venture Deals by Brad Feld. If anyone wants to get into kind of even more details, follow this call. And the three prisms that they talk about there is viewing a term sheet, and this is applicable to both term sheets for funding, but also exits as well. So kind of any corporate deal, really, we'd always kind of look at it in through these three prisms. So the economic terms of the deal: how is money coming in, how is money coming out of the business? The control terms, so that is what is an investor going to look for in terms of control over the business. Obviously, as the founders and board directors, you have day-to-day operational control of the business. So investors want some vetoes over certain actions to make sure that the business is being run correctly, and that essentially no one's going to be ripped off. I think most of these really come out of historical issues where companies have gone wrong and investors have lost money. And then the last part of that is also the administrative terms. So these are the less important but not to be ignored items within the term sheet. But the meat of any negotiation in terms of a term sheet will be around the economic terms and the control terms. So we'll start off with probably the most important, the economic terms. So jumping right into that, we'll look at what type of security is typically listed in a term sheet. So a security is just a document which outlines either a debt or an investment into a company. So the type of security can be a convertible or it can be issued shares or debt. So we'll walk through each of these now. As I'm going through as well, if anyone has questions directly, just put your hands up and we can answer them directly. Appreciate there's quite a lot of information going through an entire funding round, so it's best just to put up your hands and shout, and we'll have some FAQs at the end as well, of course. So Typically, when you're kind of approaching a round, you'll have to deal or have dealt with convertibles ahead of time. Convertibles sprung. The original one was actually a convertible loan note, which sprung out of Silicon Valley, specifically with the idea of actually saving on legal fees, mainly because full equity rounds are quite involved. They can be quite expensive, laborious. And investors and companies were looking for a quick way of getting money into the companies without a huge amount of fuss. The first thing that was developed was a convertible loan note, which is a debt instrument. And essentially here, an investor is putting a piece of debt into the company, and that debt may be either repaid or converted at a later date. So the main negotiation points around this are, the terms of those repayments, i.e. when is that going to actually be repaid, or when is it converted, and at what valuation will that debt be converted at a later date. These are probably a lot more. These were probably used a lot more with kind of non-UK investors, specifically because you can't claim SEIS or EIS relief, which I'm sure most people will be aware of. We'll mention it a bit later as well. So convertible loan notes were the kind of original convertible. And then things started to kind of develop as to a bit further on in terms of, hey, can we do this can we make this even more simpler? So the next evolution of that was the SAFE agreement, which came out of Y Combinator, and the SAFE agreement is called an agreement for future equity. And essentially what that is saying is, hey, there's no actual debt element in here. We're actually going to subscribe for equity right now. We're going to give you the cash as a company, and we're going to convert out, but we're going to receive our equity at a later date. So this is not debt. It is an equity subscription. But what we're doing is kind of kicking the can of the long form documents down the road until a future date, typically a larger funding round. The UK equivalent of this is a advanced subscription agreement, which actually took the concept of the SAFE and actually simplified it even further. If anyone's seen a SAFE, they're typically kind of 4 to 5 page, but quite dense language in there. Whereas as an advanced subscription agreement, it's probably 2 to 3 pages, very simple. It just says, hey, look, we're going to convert at a funding round or within 6 months, depending on SEIS and EIS. So again, the kind of key points to consider when you're negotiating either a SAFE agreement or an ASA, quite similar to the CLN in a lot of ways, being when is this going to convert and at what valuation. So there are the key points to consider. And that kind of summarizes all the convertibles, which I'm sure many of you may be considering ahead of a kind of a larger institutional round. So getting into the an actual funding round then and what it will be detailed on a term sheet. Typically, these, for the most part, are subscriptions for shares. So as part of the round, the investor will be investing and getting shares in exchange for their money. So early stage rounds, if you're looking at angels or potentially earlier stage funds, you just be issuing ordinary shares. So ordinary shares are what you would have issued, most people would have issued to themselves first day. And they have ordinary shares with equal rights in terms of voting, dividends, and a right to participate in the event the company is wound up. So everyone's on ordinary shares, everyone has equal rights to each of these. Now, when you're getting involved with a institutional investor, be that a VC, private equity, family office, typically they'll be looking for preferred shares. These are shares with enhanced rights that would place them above ordinary shares. And those enhanced rights can include voting, some conversion mechanics in terms of later rounds, participation, i.e. who's getting money out in the event of an exit, and anti-dilution. So again, ordinary shares to begin with amongst the founders. Preferred shares are typically brought in then once you've got a kind of an institutional investor on board. We've kind of mentioned briefly SEIS and EAS. I understand kind of everyone on the call has kind of already either raised a certain amount or kind of reached a level where I'm sure everyone's aware of SEIS and EAS. Amazing tax reliefs for UK investors. I would say they're almost a prerequisite to have advanced assurance under SEIS. If you're seeking angel funding, and also if you're looking to tap into, say, EIS funds as well in the UK. So it's an incredible tax benefit. I think it was called one of the biggest innovations to come out of the UK in the last 30 years across all technology, everything that this economy has produced. SEIS and EIS has actually been said to be one of the biggest things that the country has done well. So, of critical importance really if you're raising funds for an early stage business in the UK. And we'll talk about how to where SEIS and EIS compliance impacts as well these term sheets as we go through. But they're broadly the types of shares that you'd be looking at, ordinary and preferreds. So the next, biggest question always within a term sheet is company valuation. How do you value an early stage company? It's probably more art than science, I would say. Depending on your stage of development, there's simply less data points. So in terms of kind of the factors within that valuation, what you're looking at is, the team. Are they experienced entrepreneurs? Are they coming out of an industry that they already understand? Do they have the requisite experience, or are they second time founders? That will be looked at very closely. The numbers, obviously financial numbers may be kind of less importance, of being less available. But what we are seeing is, in the last few years, there's been heightened scrutiny around numbers. So that be revenue heading towards break even. The numbers and revenue has become of paramount importance. So it is a huge thing. And then also, the general economic climate. Obviously, we all saw boom years in 21, 22. This is kind of U-turn towards a harder funding environment generally, I would say, for the last couple of years. And now we're kind of starting to see the kind of back end of that. Obviously, we've had 2 elections both in the UK and the US. And it seems to be that technology and investment should be kind of raising back up now. I think the kind of road ahead looks a lot rosier, I would say. Then another big factor in valuation from the company perspective is, can you develop competition with other funding sources? So, can you have multiple investors trying to get in on a cap table? Not necessarily that competition leaves you in a much stronger bargaining position in terms of, hey, look, we're setting the valuation. We've got multiple investors that are willing to come onto the cap table at this valuation. So if you're not willing to come and play at that price, then let's leave the conversation. Obviously, that is a very luxurious position. A lot of companies don't find themselves in that. So you'll be looking to create that equity story and narrative in other ways as much as possible. So the next element of the term sheet will be actually calculating the share price. So what is the price per share that you're selling shares within the funding round at? That's calculated by taking the pre-money valuation that we've discussed about negotiating, and then you divide it by the fully diluted share capital immediately prior to closing. Now the important word there is fully diluted. So that is all shares that have been issued, typically to the founders or investors from the previous rounds, plus anything that can convert into shares. So that would typically be any of the convertibles that we mentioned earlier, and the option pool, which is a constant kind of back and forth then in terms of the size of the option pool and where that comes in this calculation as well. So the post-money valuation is the valuation immediately post-round. So that's taking the pre-money valuation and then adding in the amount invested. Important to look at the post-money valuation because actually that calculates the dilution of the round. So, if you've got a 4 million round and you're taking on 1 million, that's not a 25% dilution, that's actually 20% dilution because it's 1 million over 5 million, hence the 20%. So if you're looking to kind of gauge how much equity you're giving up, use the investment amount over the post money as your guide. Staggered financing is something you'd see where investors will look for investing in tranches over time. Great from an investor perspective, they're not cash out immediately. They can tie some KPIs in terms of performance, and just kind of drop in cash over time. It's not great from a company perspective. You're continuing to run on a very tight budget. You also have uncertainty in terms of like hitting those KPIs, and you just have less money to do that. Also, you can get yourself companies can find themselves in a kind of a downward spiral in that they're coming to the end of their when their next milestone should hit. If you're not hitting those numbers, it's very difficult to divert resources and time away to finding capital elsewhere. And if you're going to investors saying, hey, our current investors aren't following on because we haven't hit our KPIs, that's not a great situation to be in. So best avoided if at all possible. Demanding or asking that investors will put all money in upfront. And I would say that staggered financing would be in the minority of rounds. So if you are being asked to do it, there needs to be heavy justification for it, and ideally not entertained at all. One thing you can do to game this a bit more is say, okay, well, look, if you're giving me half the money now, half the money in 6 months, but I'm hitting all these KPIs, well, then actually what you as an investor are getting is a much more valuable company. So as a result, I should be getting a company with a higher valuation. So, you can lessen the dilution you're taking if investors agree to that increased valuation as we go along. And then one point to note here on the post-money valuation, the pre-money valuation, is around the ESOP. The ESOP, if it's coming, the employee share option plan is always a big discussion. If that's coming in as part of the pre-money valuation, essentially all shareholders, including the founders and previous shareholders, are getting diluted by that option pool, and the new money coming in is not being diluted at all. So, what you need to make sure is to minimize that dilution or put the option pool in post money so that, the incoming investors are also diluted by that option pool. The justification there being, hey, look, if you as investors are coming in, but you are going to get the benefit of the option pool on the way up, so you should increase you should either share in that dilution, or you should increase the pre-money valuation in order that we're not all diluted unnecessarily. So it's one thing to look at when you are negotiating around the size of the option pool. As well, I suppose, the ways to minimize that is limiting the option pool, increasing the valuation on the pre-money, or pushing that to the post-money. So that negotiation is typically called the option pool shuffle, where you're trying to look at the different levers and the implications actually on the cap table in terms of dilution, etc. So, just make sure that the option pool isn't something that you just say, oh yeah, 10%, it's totally standard, go for it. Actually, it's usually fairly heavily negotiated, and you see it stack up over a few rounds that you could be losing 3, 4, 5, 6%, which could have been avoided. And if you're heading for a big exit, that becomes very real in terms of cash as you develop. A bit more about the employee share option pool. Like, generally, the founders are excluded from actually getting it, being involved in it. It's used as an incentive to attract new talent and incentivize existing talent. Typically, I'd say 10% is about standard. Anything we kind of see above that, we'd be kind of questioning as to why. And then you also put in place, when awarding these employee share options, rules around vesting, which we'll come on to a bit later, and good and bad leaver provisions. So, as a general point, just be greedy with your equity. It gets sliced up quite quickly. People give it away 1%, 2% here and there, particularly to early hires who, may not be there in 12, 18, 24 months. So just, generally be greedy, I think, with your equity is probably good advice. And one thing to kind of be walking into to avoid that, 10% option pool is totally average. You guys definitely need it, you guys and girls. One way to walk into that conversation is saying, hey, look, you as an investor are giving me 18 months runway. We're paying market rate salaries. So actually the option pool, we think we only need 2 hires that actually need equity at this point in the business. They are a CTO. And actually, when we pay market rate salaries, we only need about 1% of equity anyway. So let's talk about this option pool. If you're taking unnecessary dilution, walk in there with an option plan and a hiring plan that says you actually don't need it at this point. Makes you, demonstrates that you understand your business and that you're coming into the negotiation armed with data. So the next economic term we talk about would be the rights attaching to those preferred shares. So the biggest one, and I'm sure one that rightfully a lot of founders are very wary of, is the liquidation preference. So the liquidation preference, the way to think about that is who's getting money out first at the point of either an exit or the company going bust. So it's first dibs over cash coming out of the business. These again, under SEIS and EIS, typically you can't really get a liquidation preference. It's more for kind of VC and non-SEIS and EIS investors. So the participation element, so there's two ways of doing this. You can have, essentially the investors will come and say, hey, look, we want to be guaranteed that at least a portion of the money will come to us in the first instance. So market standard would be a 1x non-participating liquidation preference. I think in the typical rounds, 90% of institutional investors will have this in there. So if you have a participating liquidation preference, a non-participating liquidation preference, what they're essentially saying is, okay, we want 1x our money back, almost guaranteed if it's there, and then we have a choice by taking this as a non-participating liquidation preference. We can either take our money back, or we can take our percentage entitlement at the point of exit. So say an investor comes in for 10%, investing £1 million, they will say, hey, we are either taking $1 million at the end or we're taking our 10%. Now, how that plays out is essentially if you are exiting the business at any valuation over and above the post-money valuation that they invested in, then they will take their shareholding because it's, there's an uplift in value there and they're going to take that out. So that would be a 1x non-participating liquidation preference. So if you see that in the term sheet, you're like, okay, this is market, this investor operates clearly in the early stage market, they understand, fine. Where it gets less company friendly is if you either say, hey, instead of 1x our money, we want 2x our money. So there you've gone into a 2x liquidation preference. So before anyone else gets money out, we want 2x our money out. And then there's either the multiple or the participation. So if you take a participating liquidation preference, what they would say is, hey, we're taking our money out first, plus we are participating for the 20%. So say, for example, in that 10 million valuation, if we had a 2x participating liquidation preference, what that investor is saying is, hey, I've come in with 1 million for 10%. The guarantee at a 10 million exit is that I'll take out 2 million out of that. So we're down to a pot of 8 million left over for everyone else. But they're saying, I don't know, actually we're taking 10% of that as well. So they've taken a 2.8 million out of the pot, and then 7.2 is left for everyone else to divvy up accordingly. So where these participation preferences really bite is at lower valuations. At the higher valuations, the pot just gets so much bigger that everyone benefits. But look, as a red flag for an investor, I would say if anyone's asking you for anything other than a 1x non-participating liquidation preference, you'd immediately hands up and be very, very wary, I would say. So we've kind of talked through these. So the next part, the other economic term other than liquidation preferences would be the anti-dilution. So anti-dilution, again, it's an economic right, and essentially it's a promise to investors that you will be that they will be compensated in the event the company issues shares at a lower share price than the current round. So in a down round situation, so if you were to raise at a 10 million valuation this round, you go out, things become difficult, you have to go out and raise at 5 million round. Essentially what the investors are saying is, well, we want some compensation here in terms of additional equity because you're now selling shares at a much cheaper price. So there's different ways of doing this. The most the standard way would be a broad-based weighted average. So essentially there what happens is you look at the price between the two different rounds, and then you look at how much is invested in that down round. So that kind of gives an average of, hey, look, how much the investor is actually affected here by both the decreased price plus the dilution of the incoming kind of investors paying less. That would be pretty standard for VC investors. The more draconian version is a full ratchet. And essentially what that says is you sold us at 10 million, you're now selling at 5 million. We reprice our entire investment downwards at 5 million. So that is like highly dilutive when you work it out on a cap table. And like I said, it would be entirely off market. So if you see a term sheet with a full ratchet anti-dilution protection, again, immediate red flag. You're dealing with people who don't understand the market and are offering you off-market terms. One additional element here is sorry, I've just kind of gone through what average and dilution. One way of, I guess, aligning incentives between investors and the company when you're talking about anti-dilution is adding a pay-to-play provision. So the pay-to-play would say, hey, look, yeah, we'll give you your anti-dilution protections, ideally the weighted average, as we said, but also you need to participate in that down round. So you need to show us support in that round, support of the business in order for you to access that anti-dilution protection. And because if you're going out and raising a down round and your current investors aren't backing you, that's incredibly difficult. So the rationale is, hey, if you're not supporting us, then you don't get the protections. And then, typically investors will put that in there. So that is the share rights. So we've gone through the types of securities that you'd be issuing, the company valuation, ESOPs and the impact of those, and then the different kind of additional economic share rights that we typical. Does anyone have any questions at this point? Conscious that that was quite a lot of information, so if anyone does, feel free. Great. So now the next part we'll move on to is the control terms. So these are, what the investors are looking for in terms of supervision, vetoes, and controls over actions that the management can take. And the reason here being that an investor may come in and only be, they'll have invested millions and millions of pounds, but actually on a shareholding basis, they might actually be quite small. And so, fundamentally, if these protections weren't in place, typically the founders can, operate the business by passing shareholder resolutions, be that, ordinary resolutions or special resolutions, and can just kind of essentially run the company as they wish if these protections weren't in place. First thing it will be around the control will be around, hey, who can buy shares in this company? So, typically you'll want control here, both from the founder perspective, but also the investor perspective as to who can invest and who can buy into the business. Preemption on a share issuance is essentially saying, hey, look, we will give everyone the opportunity, all of our existing shareholders, the opportunity to invest in the business before we before we offer these shares to third parties. Very standard, nothing really, not a great deal of criticism here. What you do want to make sure is that everyone just has a pro rata entitlement, after which the board can decide who they issue shares to. And the reason being here is that if all shareholders are entitled to take up over and above their pro rata, typically when you look at the cap table, there's only founders typically can't kind of follow on and keep investing in the company. It's typically investors that will have the kind of firepower. So if you have an investor that is not working out, or you just don't feel you're particularly aligned with, if they are entitled to take up the full round, they can build up very large stakes in the company very quickly. So again, you typically reserve board control for the actual allocation of the round over and beyond the pro rata entitlement of each shareholder. Similarly, if any individual shareholders on the cap table are going to sell their shares, typically you'd offer them first to everyone on the cap table as a priority. Again, noting, typically the only ones with the pockets the pockets deep enough to actually buy these shares are the other investors. So again, you just want to make sure that. And also, a lot of times funds will seek to actually waive these in certain scenarios, whether that be kind of transferring to funds within their group. Some will insist just unrestricted transfer rights, that they can buy and sell in and out of companies unrestricted. Again, we'd counsel against that very strongly. If you've kind of essentially taken on an investor based on their profile, their relationship, you should have some say in terms of who they would sell to. So I think Revolut are having a bit of an issue with this at the moment, that their Crowdcube investors have been offered to exit to a private equity firm, and they're having a big back and forth about that at the moment. Crowdfund have amended their articles, and that's now being challenged by the incoming investor. So, who ends up on your cap table is an important consideration. So, you should always be mindful of that as you're going through. So the drag along it would be the next one. So the drag along is the ability to actually force an exit at the end of the journey. So you can ultimately, it would be the action of a majority of shareholders. Typically 50% of shareholders could vote and say, hey, look, we want to, right, this is a good price. Let's get out and sell the company. And what you don't want is to be held hostage by, say, someone holding 2% of the company saying, no, I don't want to budge, I want to hold on to this. Now, that any acquirer will want to buy 100% of the shares, so they'll be saying, look, if you can't deliver 100% of the shares in the company, we don't want to even entertain negotiation. So it's important to get this in, and then the conditionality around it really is kind of where the negotiation takes place. So if typically investors will want to be part of the dragging majority, mainly so that they are getting a return on their money, right? So if an investor invests in 10 million and invests at 10 million, takes 10%, at a 20 million exit, the founders are obviously left with 90% of that. So at a 20 million exit, that looks like a good times for the founders. The investors are looking at and saying, hey, we've got a good investment here and we're only getting 2 times our money. So actually, no, we don't agree with this. We can't be dragged in those situations. Typically where you kind of want to get to is that at some valuation, the control comes back to the management teams in terms of being able to exit the business. So this is a lot easier to negotiate at earlier rounds with investors who aren't kind of VC return focused. So it's an important consideration when you're getting investors onto your cap table. What is their expectations in terms of return? If it's a traditional VC, it's kind of moonshot or nothing. If you've got maybe a family office that's only interested in 2 or 3 times return, they're probably more amenable to putting in a valuation that is commensurate with those returns. So it really is important to make sure that outcomes are aligned from the outset. Now, again, those outcomes need to be aligned with your own motivations here. So there's no point kind of going to a VC investor and saying, yeah, we want to go to the moon, but also we take a 2x exit as well. So it's important to kind of be careful about that narrative and shape it accordingly as well. Obviously, from a founder's perspective, you would also include yourself in the dragging majority. At the initial stages, you'd have sufficient shareholding that you wouldn't be able to be outvoted. But as the rounds go on and dilution increases and your shareholding drops, below that majority, just make sure that you are involved in that decision making process as well. So tag along, so that's drag along, the ability to force an exit. And tag along then is the inverse. So that would be if, say, a majority of shareholders just say, yeah, we're going to sell, but we're going to leave half the company behind. What you don't want to be is kind of left on the shelf as an investor or a minority shareholder. So this protection is in place then to say, hey, look, if you're selling 50% of the company, it needs to be 50% of all shareholders, or at least the shareholders that put forward that they want to exit. So there, it's making sure that you have liquidity in that as well. So one of the other control terms is around reporting, making sure that investors have oversight of the business. Typically in a term sheet, you'll see that coming out in the shape of either quarterly or monthly reporting. Obviously from an operational perspective, it's easier to get quarterly reporting. Some funds have upward reporting responsibilities to their LPs, so they may insist on monthly reporting. The position you want to get to here is that the reporting is, high quality, provides your investors with everything they need, but is not a huge operational burden so that you're being dragged away from the business to produce monthly reports. So typically what you kind of look for is, hey, look, we'll pull off our financials off Zero or our accounting systems. We'll agree some KPIs in terms of what we can pull in terms of data. And then, we'll also discuss all this in board meetings, which we'll come on to. So yeah, you want to limit the operational impact and that. One thing I would say though is, the founders we see that kind of keep investors close, are constantly updating in terms of progress, asks, etc. They are typically the ones who seem to go on and raise subsequent rounds because they're keeping investors updated. They're engaged, they're leveraging them for support. And they don't kind of just drop them and just come back 18 months later and say we need more money. Keeping that investor relations and investor management piece is a really important piece to consider in the grand scheme of actually running the business, of course. So next thing we come on to is to management and the board. So I think 90%, probably more, of term sheets will mention the structure of the board and what investors will look like. From a founder perspective, ideally you want to maintain control at both board and shareholder level in so much as possible. At a board level, that would be each of the founders are sitting on the board. And then, what investors at each round are looking for a seat. If you're giving away one seat per round, you quickly become outnumbered. So it's important to manage this process, thinking about both the immediate round and any subsequent rounds as well. So a lot of investors will either look for an actual director role or an observer role. An observer is a non-voting role of people who can attend meetings. Obviously, anyone in the room in meetings can often influence outcomes, so it's just something to consider. And what in order to avoid stacking directors round and round and round, what you want to make sure is that there is a minimum shareholding associated with any appointment rights. So, if an investor is coming in for 10%, make sure that they have board appointment rights only while they maintain that 10%, ideally. So if they're diluted by the next round, they fall off the board, and then incoming investors then would invest. So that would be the ideal way. And yeah, that's kind of typically how board seats are done. Veto rights then would be reserved matters that are typically, a list at the back of the term sheet. It says, the company will not take certain actions without the consent of the investors. So how that investor is, how those consents or reserve matters are dealt with, they can be dealt with by, a board vote, an investor director veto, so specific rights appointed to the investor director. They can be dealt with at shareholder level by a vote of the shareholders or by an investor majority. So, if you have multiple investors on the cap table, you can group them all into one, say, 20% group, and you say, of that 20%, we need an investor majority. So we need at least, 10.01% to approve certain actions. And then if you've got, one large investor who's leading the round, oftentimes they'll say, hey, look, we're going to be very close to the company. We're going to be sitting on the board. We're going to be, we've invested the most money. So actually we want specific vetoes or controls put in place for us reflecting our position in the company. These are, there'll be a big typical long list. If you take a look at the BVCA documents, there's a list in there. What you want to do is review each of these in terms of making sure that they are suitable for your business, both in stage and your actual operations. So there'll be restrictions around taking out any debt, hiring decisions over a certain perspective, annual budget approvals. So there'll be a list of these. So you really need to look at it and say, okay, well, maybe I was running my business myself up to now. I'm taking on this investment, and now I'm going to have to, have all these vetoes. So I guess the question is, can you still operate this business efficiently, move quickly, and continue to function? And then, who do you actually have to go to for these decisions? So, if it's an investor director, that should just be an email sign off. If it's an investor majority, it involves more people around the table, coordinating busy people just to get an answer. So really the balance is between operational efficiency and obviously giving investors sufficient comfort such that they're willing to invest as well. So things to consider there. One thing I would say, that I'd advise, anyone in a business that's going into a deal is, the critical things typically for early stage technology companies is, can we raise more money? And, will I as a founder see an exit at some point? So, if I was kind of looking at a term sheet selfishly from a founder perspective, I'd be saying, okay, can the investors block me raising any investment? Yes or no? And then the second thing will be, when we actually get a knock on the door to buy this company, can I actually sell it? So looking at those two pieces, just be wary of the veto rights and any controls here around those two kind of core actions. Now, some investors will just say, you can't, you're taking our money, and we need to be involved in each of those decisions. And there's ways of counter arguing those as well, which any expert VC lawyers that should be able to do. So yeah, we can discuss those. We kind of covered that as well. The next control term would be around restrictions on founders. So share restrictions. So typically this is communicated to the investors that you are going to stick around once they've invested. So this is typically around vesting. So vesting, in terms of the kind of starting position for most institutional investors, they'll be saying, oh, it's a 4-year vesting period with a 1-year cliff. Now, what that means is you're committing to stick around for 4 years. If you leave at any time within that 4 years, you lose some of your equity. So the cliff element is if you leave any time in the first year, you would lose all of your equity. And then post-cliff, the vesting would be dividing the remaining period monthly, and then at each month you are essentially saying you've earned that equity over time. So within this, I would say the way to kind of navigate this and get things kind of back on more of an even keel would be saying, hey, look, it's a 4-year vesting. I've already operated within the business for 3 years. I think a portion of my equity is already earned, so that should just be completely taken off the table. I've already passed this cliff, so we're just taking that off the table. And a lot of the times where you kind of see this shaking out is probably a 50% of equity subject to vesting over, say, a 2-year period. And the argument around that would be, hey, we've worked already. You're actually only giving us 18 months of runway or 24 months anyway, so that's that. And then you'd negotiate around good and bad leaver provisions as well. So typically bad leaver, you'd lose everything, or at least everything that is subject to vesting. And a good leaver, you may be able to leave and sell at a fair market value. they're kind of broadly where people get to. One thing I would say as well is, amongst co-founders, obviously vesting is also protecting, your interests in the event a co-founder were to leave after 6 months and kind of you're left there with a load of equity on the table, or sorry, your co-founder has left, but is obviously getting all the upside of all the work that you'll be continuing to do. So it's also kind of a defensive mechanism amongst founders as well. So just something to consider there as well. One thing I would say as well is subsequent investors, when a co-founder leaves and has a big portion of equity left on the table, a lot of the time, the next round of investors will come in and say, we're not investing unless that 15% that's being held by a co-founder, if they're no longer invested in the business, that needs to be either given back or put into the option pool. That's typically a fairly standard conversation as well. So just something to kind of bear in mind, both if you are leaving the business, that your equity may be negotiated downwards after, but also if you're staying in the business, that may be a conversation you may need to have. So that is the kind of the guts of the economic and control terms. The last piece is around just the administrative terms. We'll just fly through conscious of time. So documentation, that's typically a shareholders agreement, a subscription agreement, a set of articles, your own employment agreements, and a disclosure letter around the warranties. So the information rights we've kind of gone through. The use of proceeds, so you will be required obviously to come up with a financial model that will be signed off by everyone pre-exit. Pre-round. So just be mindful of that. You will be required to put in place insurance, so key man, directors and officers insurance as well. So again, something to kind of think about. And then your own employment contracts, as well as a huge part of this as well, typically in diligence that comes out, is IP assignment. So, the investors will be sending in their lawyers to comb through your data room and opine on whether all IP in the company that has been created to date from the outset of the company has actually properly been assigned into the company. So that's typically done under consultancy agreements, employment agreements, or IP assignment agreements. I would just say get those in place as early as possible, because there's nothing worse than around waiting to sign when someone who worked in the business 4 years ago is currently backpacking around the world and can't be reached. It's not a good look, and it genuinely does hold up both funding rounds and exits. So make sure that your IP is properly being assigned into the company at every stage. You'll also be required to give warranties, which are statements about the company, the business, yourselves, that if shown to be false and that the investors have made a loss as a result of those breached warranties, that you could be personally liable for. So, it's something to concentrate the mind around making sure the investors know everything that they should about the business to give them an informed decision about their investment. So it's they're rarely litigated, but there is potential personal liability there. It's probably the only place really within the structure that you could be personally liable. So just make sure that you're there. And then in terms of getting your shit together, what does that look like? As I said, your investors' lawyers are going to be sending in lawyers to complete due diligence on your company. So making sure that you've got all your corporate records, constitutional documents in place, i.e. everyone knows what shares are owned by who. Your business and your financials obviously need to be up to date and kind of ready to go as well. And then your IP, I mentioned already in terms of IP that's being generated, but also anything that's registerable as well. Get them in and be ready to go. Your material agreements, commercial contracts. If you're saying you've got contracted revenue, make sure it is contracted revenue. At the point of exit, that often gets chipped if you don't have proper commercial contracts in place, because they say, hey, we're buying this business, but the onward party is not actually stuck. Is not actually properly contracted. Any disputes in litigation, if you're receiving any letters, make sure that you're either putting those to bed or are disclosing them as well. So just be aware. And then any employee or HR issues, making sure you've got robust agreements in place, employee and policies. One thing I would say as well is, obviously it's very flattering getting a term sheet. Um, the world of kind of VC and family office can oftentimes be opaque. So it is really important to actually do diligence on your investors. Best way to do that would be, getting references in with other founders in the portfolio, looking at their portfolio to see, are they still alive? Have they secured onward funding after? A big question to investors is, hey, it's great that you're investing, but obviously we need to follow on investment, seek follow on investment. Do you follow on, or do you have funds that you feed upwards into that you'll be happy to introduce to keep us going? What stage of the life cycle of the fund are they at? Is this their last investment or is their first investment? Do they have loads of dry powder to help you out, or is this just kind of the end of the road? And yeah, I think that would be kind of everything that I'd be doing. But the most important thing really is talking to other companies and the investors. We had a instance lad in early on in the year, which the negotiation with the VCs was actually becoming so heated that the founders were almost walking away. It was probably we were kind of doing several deals that were like 10x the amount, but this one deal was an absolute bloody nightmare, to the point where the founders were actually almost willing to walk away. But having spoke with their portfolio, they said, look, the experience of negotiating the round was very similar, but post round they've been fantastic. So having that insight then actually caused them not to walk away, and everything's going well for them. So yeah, speak with people who are one step ahead of you. It's always a good best way to learn. And then if you are looking for a DD guide, Y Combinator have a really useful Series A guide and a folder structure, which I think we've actually distilled down into our own as well, so we can share that as well. So I think that is everything from me.
Thank you so much. Do you want to stop sharing your screen and then you'll be able to see everyone?
Yeah.
There's 3 questions in the chat, all
Great.
from Marcus. So I'll ask them whilst they're here. So do you know what returns angel investors are typically looking for compared to VCs who are looking for on the level?
Yeah, 1 to 3, I would say, probably. They'll say more, but I think if you gave most investors who probably invested SEIS over the last few years, myself included, a 3x return at this point, a lot of them would bite your hand off for it. I think overall as an asset class, angel investment, you're meant to get to 20 investors. 20 investments that typically then return about 3x. So you need to get to that number to actually give that kind of level of returns. So yeah, but I think you have the conversation with them as well.
Yeah. Thank you. And then the next one was, do you see founders getting salaries from once they've raised, and what kind of market size do you see in terms of the salaries? They tend to be minimal or generous?
I would say not banking salaries, but certainly I think there's been a much more acknowledgement that actually, if founders aren't earning a salary, they can't really run the business. There's been studies shown that if you're under financial pressure, your IQ drops 10 points. And to put that in context, being stoned drops to about 5 points. So, I think investors are obviously coming around to the idea that actually this is not a great idea to have founders under massive financial pressure. So, but I think Carter released some good data recently. I think had a Series A, it's around 100 to 120, and then kind of sliding downwards from there. So yeah.
On that question, I don't know if anyone follows Sam Marchant, who used to be a VC. He posts a lot about kind of general fundraising tips, but he posted something about founder salaries last week on LinkedIn, so you can have a look at that as well.
Good.
And then another question from Marcus: would investors want to see employees' actual contracts?
Yeah, they'll definitely want to see at least one. To just understand, have you got all the proper provisions in there in terms of IP assignment, etc. So yeah.
And then last one in the chat, which is just if anyone has a specific question for you, what's the best way for them to get in contact? Have you got an email address or LinkedIn or something you can share?
Yeah. LinkedIn or bill@7legal.co.uk as well. And we're happy to give, a 30-minute consultation as well for free, either talking about term sheets or, any other legal issues you have as well.
And
Perfect.
just we didn't, sorry, Sam and I from Seven Legal, I've been sitting in the background, but we in the slide deck as well, which I'm sure you guys will get, we've got our Calendly link for that call as well. So feel free to drop time in, and like Bill said, we can chat term sheets or we can chat, specific other legal question you may have along the way as well.
Perfect. Yeah, if you can share that with me, the presentation with me, I can share it with the rest of the cohort as well. And we'll send your email address around too. Thank you so much for your time.
We actually have another question in the chat, and I have a quick question too. Question from John is basically what happens to the founder shares if they die?
So by law, unless it's dealt with in the articles, they would pass to the estate. So they've just passed down through intestacy. Typically, people, there's different ways of doing it. Essentially, some people will take out an insurance policy such that the policy cashes out, and that founder would estate shares will be bought out of that policy. It's probably a good thing for any business to run as well. Mostly, either you as a co-founder or any institutional investor, they're obviously backing you as individuals. They're not backing your wife, your son, wherever this passes to. So normally there is an exit off the cap table. As I said, either purchase at fair market value, or typically kind of purchase at fair market value be seen.
I have a question too. So I was chatting with my friend, who's an attorney over the weekend, and she works with a lot of startups, and she said one common challenge she sees is when founders are working with an attorney to draw up a commercial contract. She's seen that a lot of attorneys will add in a bunch of clauses that are possibly unnecessary, just to be extra cautious, but then it ends up costing more money. So is there a way that founders can, who don't have legal expertise, can kind of, I guess, gauge what terms are critical to have in a contract and which are a bit less, unnecessary?
Yeah, I feel that one, Bill, if you want.
Yeah, so
so I think it's about getting the right type of lawyer in to review a contract or to create the template for you, because in this stage of company, your priorities really are getting revenue in. So if it's your standard template contract, yes, there's things to protect yourself with, but then there's also just time to revenue, get the deal done, and make sure it's as kind of vanilla and neutral as possible. So I would say it's working with the right type of lawyer, understanding what the likelihood as well as the severity of risks, and then thinking about, okay, well, do we really care too much about that at this stage, and is it a theoretical thing that probably won't happen? I think it's just understanding your risk profile and where you are, and again, we work with clients all the time to do that. Yes, if you go to kind of certain types of lawyers, they'll just protect themselves really and their professional indemnity by chucking everything in, and frankly, unraveling that in every negotiation costs you more as a business than the potential risk of something going wrong one day. So yeah, happy to chat with anyone about that sort of thing specifically, but also it's just something to bear in mind, getting a contract that's streamlined, short and sweet, and does cover your risks is the best way to go, and then you just minimize the kind of pain of negotiating.
Perfect. It's useful. Thanks. Any final questions? All right. We'll share the deck, and I know Putty's already put your email in the chat. So big thank you to the both of you. Founders, stick around for one moment. We'll say goodbye to Seven Legal now.
Great.
Thank
Thanks,
you
guys.
so much.
Cheers.
I'm just going to stop recording as well.